Welcome to Tell Me More for Run Radio. My name is Trina Wilcox, and Lane from PassiveCashFlow.com is joining me today. Hello.
Good, good. SimplePassiveCashFlow.com is the URL, but that's fine. Hello, everybody.
I'm used to runradio.net, so it sticks in people's heads. So I always add it so people know where they can go to find out more information. So tell me about all the things you've learned. You've done quite a bit of things. You've done writing, you've done telling people how they can make more money. So how did you start learning how you could make more money?
Yeah, so I started as an engineer on this linear path that I think a lot of my clients, they were taught to go to school, study hard, work at our jobs, and then invest in the old 401k, all these retail investments, and just kind of buy a house to live in. And maybe in 40 to 50 years, it'll work for your retirement. But shortly after graduating, I bought a house to live in and I turned it into a rental. And that's when my aha moment was, where I discovered how the wealthy make money, by buying assets such as rental properties and, making money four ways with cash flow appreciation, tax benefits, and the fact that your tenants are paying down your mortgage for you.
So how would one get started with that? Because a lot of people, especially if you're a college kid, you're worried about buying books and not real estate.
Yeah, so I mean, I guess maybe we'll kind of start at the top, right? I mean, the type of real estate investing that I work with my clients it's not for the broke guys, right? If you don't, a lot of this is capital intensive. If you don't have money, you don't have 20, $30,000 for a 20% down payment on $100,000 house, you got to get that, right? There are a lot of programs out there that I'm not huge fans of where they trick people into, spending all this money on a program where, you know, they don't have money to begin with, right? But where I kind of work with people who have six-figure jobs, they have successful businesses. All right, now what do, right? How do they effectively use leverage and debt, and how do they best buying the best cash flowing investments, and build a slow and steady portfolio that kind of takes advantages of the tax benefits along the way.
So how long after you said you started renting out your first property, how long did it take you to start seeing money from that and for you to automatically turn it around and start making more money from other properties, or what'd you do next?
Yeah, I mean, in the beginning, it's slow. It's like this is not a get rich quick scheme here. I mean, each rental property, maybe I got a few $100s of extra cash flow every single month. Call it 3, 4 grand a year. But I had a good paying job, and my biggest advantage was I was a good saver. I made close to six figures out of college, and I was able to save 30, 40 grand a year. Part of that didn't have kids at that time, and I kind of lived very frugally. So, you just after a while, you just kind of stack that on top of each other. And, it took me like 7 or 8 years to get up to 11 rental properties. And then it's more meaningful at that point, right? Because instead of a few $100s a month, it's a few $1,000s a month of passive cash flow. And that was how I became more of an accredited investor past that very important $1 million net worth threshold. And then I kind of discovered how the wealthy invest, where they have less time. They don't really invest in little rental properties anymore. They start to invest in syndications and private placements and start to be more of a sophisticated investor by diversifying themselves across other rental properties, large apartments, get into different asset classes, and go into these more private placements is what it's called.
Wow. So, so how would you tell someone to start learning more about all of this if they're even interested at all?
Yeah, I mean, I think that the thing is there's so much like financial advice out there, right?
Hmm.
What I tell people is you never take financial advice from people who are not financially free. And what the other thing people have to understand is most of the financial advice out there are predicated to people who are not really good at their finances, right? So, there are folks out there like the Dave Ramseys, the Susie Ormans, very basic financial advice where they tell you don't go into debt. Of course, you don't want to go into credit card, high consumer debt, right? But they are kind of they, their advice is kind of focused towards people who spend more than they make, right? They can't keep a budget or they don't make that much money, right? So a lot of my clients, they make multiple six figures at their day jobs and they are good savers. Definitely the Dave Ramsey, Susie Orman path is the wrong way for them to go. But it's
Okay.
confusing, right? Because that
Okay.
is, I think, the advice that most people in this world should go after. like for example, buying your own house to live in. I don't necessarily think that that's good financial advice for people who are really good with their money. But for most people out there, it becomes a forced piggy bank, right? Because if people didn't have to throw few thousand dollars into their mortgage, they blow it on something, right?
Mhm. I think the way we're working with our money and saving our money is definitely changing from what a lot of us grew up with. Like you said, those goals used to be a little bit different and not necessarily the best way to get ahead. What are some suggestions you would make to someone who is doing pretty well in their job to maybe think differently about than maybe what we were taught growing up?
Yeah, I mean, all it comes down to, and we're kind of speaking to those who, are able to save $5,000, $10,000 plus a year, right? It comes down to where's the best use for your money, right? Paying off your mortgage, for example. That's something that the wealthy don't do, right? They try and grab as much low interest debt as possible, and they use that to buy assets that increase in value or produce cash flow for them, ideally in cash flowing rental properties. Now, by paying off your house, what you're doing is you're just putting money towards your equity, and it's not really increasing more money for you, right? So that's kind of the opposite what you want to be doing. But, again, in contrast, for most people in this world, that's kind of the paradigm that they live in. They're trying to pay off their debt. They're trying to pay off their mortgages. Instead, what people should do is they should go on the offense and go buy more and more rental properties or go into syndications and private placements. You take the average kind of older American who's kind of taught to pay off their mortgage, right? They may have $1 million of equity in their house, but they're house rich and cash poor. That's no way to live. But what if somebody, came into our group and started to educate themselves the right way, and before they start to pay down their mortgage, start to take that money and go buy other rental properties with it, right? Their net worth would vastly improve and increase over the time horizon in that same time period. It's just a numbers perspective, and it's this concept of return on equity, right? The more equity you have in your house, I mean, people think it's better, but it's more like your percent. How much is your equity growing over time? If your money's in your house, it's not working for you. It's merely going up with the pace of inflation. So now gets out of the comfort zone for a lot of people, right? If I know where my money is in my house, I know it's there. But now you're telling me I need to go find other investments to go into, and that perceivably increases risk, right? But
Mhm.
in terms of like the reward, right, being vastly being able to increase your net worth over time with prudent investments, that's I think what requires education and a network around yourself.
So, what are a few of those risks that you would recommend someone take?
Well, buying rental properties or going into deals where it's ran by a professional operator. One of the ways that we kind of mitigate the risk is, you're going into investments that cash flow, right? The people who got hurt in 2008 gambling on appreciation were, these people that just thought that the prices of homes would keep going up and up and up, which it doesn't always. What you want to be doing is going into investments that cash flow. So, I mean, here's a quick exercise for everybody. I mean, go and look at your house or a rental property that you may think is good out there. Take a look at the price to purchase and take a look at the rents. One thing that we kind of look for is this 1% rent to value ratio. So if you take the monthly rents divided by the purchase price, we're looking for that to be 1% or higher. So a lot of like the starter rental properties people will start out in our community would be like $100,000 home that rents for $1,000 a month. 1,000 by 100 grand, that right there is about 1%. So, a lot of our clients live in high priced areas like in DC or Los Angeles, San Francisco. You'll be lucky to find a place in a rough area for 400 grand that'll rent for $2,000 a month. That's not going to work. 2,000 divided by 400 grand is 0.5%, much less than the 1% rule. So the reason why that's important is even in tough times when, your price of your property goes down for a little bit, it doesn't go down like FTX to zero, right? That's the nice thing about real estate. But even when it does go down, maybe 20, 30%, you don't really care because you're holding onto the asset and your tenants are paying down your debt service and you're still cash flowing at that point if you kind of stick to these rules. We've got like a free analyzer for people on the website with tutorial videos if people want to grab for free at simplepassivecashflow.com/analyzer if you really want to dig into the numbers. But that's where like every investment that you go into to mitigate the risk, you go into things that positively cash flow as a baseline individually. So you start to build basically these mini pensions. And I think this is where a lot of financial wealth building has it backwards, right? I think, when I got out of college, started working, they brought over that so-called financial planner to go talk to everybody. And that whole plan was, all right, build this big pile of cash and then live off of it after a while. And then at that point, you're able to live off of it. Sorry, let me turn this up. So, build up this big pile of cash. And then when you become 60 or 70 years old, quote unquote, retirement age, you're able to live off of the remains of it. The problem is you're eating through your pile and you need to convert that into cash flow at that time. And that's exactly what they want. They want you to put your money with them so they can get the fees of assets under management. And this is the current financial complex, how the whole industry is created. But really what you want is that cash flow at the end, right? To begin with the end in mind, you want cash flow. So what we kind of suggest is we'll start building these little mini streams of cash flow today, mini pensions in the form of little syndications or rental properties, right? And start to titrate up there. The cool thing is while you're working your day jobs in your 20s, 30s, and 40s, you don't need to eat that money. You don't need to live off of it yet. So it can be used to buy more and more of these cash flow streams. And at that point, it just kind of just grows upon each other. And you don't have to be in this predicament at the end of your life trying to convert it over to cash flow streams.
So about how long was it that you started seeing that you had something that you could share with other people?
Yeah, so again, I started bought my first rental in 2009. Started renting it out. I didn't buy another rental property until a few years later, and that's the
Okay.
hard part, right? Like, there's not a get rich quick scheme. You have to save up money, whether that's 30 grand, 50 grand, 60 grand for a 20% down payment. There's no tricks, right? Tricks are for
Mhm.
kids. There's no tricks to this. If there was, I'd probably be scamming people out of money to teach them all these random strategies that don't work anymore, quite honestly, right? I
Right.
just basically teach hard work and grit and saving your money for down payments. That's really what it comes down to. But yeah, like as the years gone by, I just kind of bought more and more properties. And then around 2015, I had 11 of these properties. And that was when, I got up to several $1,000s of passive cash flow. It didn't replace my salary, but it was a good portion of it. It kind of
Yeah.
seemed like a third paycheck every month. And at that point, I started to trade in those little rental properties for larger syndication deals, which is primarily how I invest these days, right? Because I don't want to deal with tenants, termites, and toilets with little rental properties. I want to be a passive LP investor in a larger deal ran by a operator who's professional and has a professional company. But the important thing here, unlike investing in a REIT or the stock market mutual funds, where there's gazillion middlemen taking all your returns, I'm direct with the operator, and it's in a way I'm not into a retail and type of investment. I'm into a more wholesale type of investment where there's just all these middlemen removed. And I think that's my
Okay.
biggest qualm with way people normally invest is they're in these like fee-laden products that ultimately just take the retirement away from people. And that's why it takes so damn long for people to ever get retired, if any.
Mhm.
If people just kind of did what I said and bought a handful of rental properties and kind of stepped up and managed their return on equity on their portfolio, most of my clients, like, if they have $1.5 million net worth, then they are able to save $50,000-$100,000, can get financially free in 4 to 6 years doing it this way, especially when you combo, the tax strategies where you're making passive losses through these real estate investments and then you're not paying taxes legally. And then, you do this other concept called infinite banking that people can Google at home. We have an e-course on this for free for people. But, these are simple strategies that I found myself maybe about 6-7 years ago. I had owned rental properties, but it wasn't until I started to join higher level masterminds with other accredited investors, other high network doctors, lawyers, engineers like myself, who were implementing a lot of these strategies of the wealthy. But a lot of these strategies are very counterintuitive to what our parents have taught us, what our friends and family in the cubicle world do. And I think that's why, I'm so passionate about it, because it's like, it's so attainable to the average person, but we're all taught to do it the backwards way.
Yeah.
But I mean, you say why, right? And it's like, well, the whole, you know, financial industrial complex is predicated on people blindly going into this high fee products. And if everybody got FI in 4 to 10 years, then who would be our doctors? Who would be our lawyers? Who would be our engineers? I guess maybe we should keep the lawyers working for as long as possible. But like, why, if it were that easy, then like, who would work, right? You can't have a society
Yeah.
run like that. But a lot of this stuff is like, it's very counterintuitive. And I think that's where you need like that aha moment of, you need to get around other investors who are, getting HELOCs out of their home equity and putting it in, turning it into a few syndication deals or rental properties. It's very counterintuitive, out of your comfort zone. And that's kind of what we also provide to, retreats and events for people to interact and, not feel like the strange person in their peer group who are buying a rental property.
What about the person listening to this that they're making money and working, maybe not quite to the level that you're talking about? Do you think it's smart to take out loans for these things to get the ball rolling? Or is that not your
I mean, that's the only way you're
recommendation?
going to be able to do it, right? Like, I mean, for most people, like just take your house, for example, that you live in. You'll never be able to afford it if you never take out a loan, right? But, going back to like, well, buy something that's fiscally sound, right? And it doesn't come down to like how much down you put for down payment. It comes down to the asset, right? What's the rent to value ratio on that thing? If you buy stuff that are good rent to value machines, then after a while, the asset will kind of pay for itself. It literally will, month after month, right? And I think that's the key difference. Most people buy things that don't cash flow, and quite frankly, to me, aren't very good investments. But for people starting out, you have to take out leverage. You have to use the financial system that the banks use on your side. You don't have enough like firepower. You can't play that game where you should buy stuff cash. Yeah.
So what's coming up for you? Do you have a retreat coming up that people can get in on, or what's next?
Yeah, so I mean, a lot of the stuff is free on my website. Like I said, I never really liked, these scammers that would come around these conferences and trick people who, without money, how to wholesale houses and flip houses. I don't do any of that type of stuff. That's stuff for like if you have a lot of time on your hands. I kind of focus on people who, already have good jobs or good businesses that are already making money. But how do you best effectively manage your finances and your investments with the minimum effective dose, right? The least amount of time. Um, and that just is quite frankly just going into good investments where you cash flow and then you hire property managers, do your dirty work, or you go into syndications deals of LP. Excuse me. But a lot of this is like the tax strategies, right? I mean, like we have some doctors making like $800,000 a year. They must pay like $250,000 in taxes unless they can get on board with like a real estate professional status on their taxes, use the real estate losses to lower their income, and vastly, maybe drop their income down to 400, 500,000, saving a couple $100,000 right there in taxes, all legally, right? The IRS, I mean, the whole handbook on the IRS is like everybody does the 1040 easy form, right? But the whole book is ways that they're incentivizing us to invest in things like real estate. And those incentives is to pay less taxes because we're the ones putting the money where they want us to, where the government wants to incentivize the flow of money to go to. So it's really up to us to kind of understand this type of stuff, not our CPAs. The CPA's job is just to do the little paperwork and forms and file it. But I think it's our job to understand how taxes work in a nutshell, right? What are the incentives, the way to guide my way I do my rental properties, my investments, and my business.
All right. Thank you so much for sharing your information. Remind people where they can go to learn more about Simple Passive Cash Flow.
Yeah, if they want to kind of follow my journey, they can go to simplepassivecashflow.com. We've got a podcast, Passive Real Estate Investing via Simple Passive Cash Flow. And if you guys are interested in more of that information, you guys can join our group at simplepassivecashflow.com/club.
All right. Thanks so much.
Thanks, Sharina. Bye.